right. Good morning. Happy Monday. How
And
was
a good day to you, sir.
your weekend?
I busy. I did a lot of work. I did yard work, school work. I didn't really have much time for a weekend, but that's okay because next weekend we're going out of town for my mom's birthday. So
Oh, very
yeah,
cool. Where to?
want to chill out. Deep Creek Lake in Maryland. It's about an hour from where I grew up, and she's turning 60 this year. So all the kids got together and rented a huge house with an indoor swimming pool, so the kids will be entertained the whole time. And yeah,
Well, that's good that you can do that kind of thing again,
yeah,
right? Yeah. So we had a nice weekend. We went to the botanical garden, but before that, yesterday morning, I'm walking my dog. It's like 7:30 a.m. So it's quiet here on the beach, but sun's starting to come out, so I can tell it's probably going to be a busy day. And I just sense there's a car pulled up behind me as I'm just kind of standing there with my dog sniffing something. And I look back and it's like an old station wagon with this kind of disheveled guy in it. And it looks like he has a bandage on his arm and he's bleeding. And he kind of just looks at me and he sighs and he goes, "You seen a pit bull?" And I was like, no. And and I got to thinking he's just kind of driving around looking for this dog. And I love pit bulls. I'm sure they're all great and stuff, but at the same time, it looks like this guy get bit. There's about to be kids everywhere. So I ended up calling the reporting it in. I tried to call animal control, but I had to call the cops and let them know. But I didn't. I thought he at least needed help looking for the
yeah.
dog because I had my dog and I was like, I can't help my dog will get in a fight. That won't be helpful.
And
So that
that didn't help him that he doesn't have any teeth either. So,
yeah, he just instigates it. He got into a fight with my college roommate's dog, a puppy. They got into it pretty good because the puppy didn't know any better.
yeah.
Anyways, but no, that was interesting times in this neighborhood.
Funny story. I just saw a thing in the news about some neighborhood in Houston where there was a tiger on the loose for like a week.
Of course, we're in Texas, America. Why wouldn't there be? I mean, I'm from Ohio, where a whole zoo got loose once, and they had to go around and shoot them all.
Yeah.
Some some
Oh,
guy,
yeah. I
some
remember that.
guy
That
went
was really
crazy.
sad.
Zanesville, yeah, of course, as is Tiger King and all that kind of stuff. So,
We got to do an episode on Tiger King one day, just to have fun with it.
well, I mean, there's an investment story to it if you think about it.
Yeah.
He was breeding, buying, and so it was a business, um, and it was very wild what they were doing there. But I'm sure they had all sorts of strange life insurance policies on their employees. Can you imagine?
I don't know. I mean, yeah, it's possible if they were smart, they would.
That one girl got her arm bitten off.
Yeah, yeah, that's definitely something that falls more under the liability portion. But yeah, it would be. I guess employers can have group policies. That's one of the things we're going to talk about today. Terming group life insurance.
Yeah, let's go for it.
All right, so we did the overview where we kind of talked about all life insurance in general, and then we did the permanent one on Friday, which I think that one went way longer because you and I can just talk about that for a very long time. And so that's the offensive portion of the strategy, where you get the protection. You also get the chance to build some equity that's protected from market loss and taxes. And it's there for your entire life. So, one of the things about that though is you need something to bridge the gap between now, like where you're at now, and take care of the deficit between now and 20 or 30 years from now, when you've accumulated enough other assets too to be able to kind of self-insure, I guess would be a good way of putting it. But that's where the defensive portion of the strategy comes in, and I think it's just as important as the offensive part. You need to to make sure that you're covering all your bases. Because as much as I hate hearing people say that question, like it's in the description, like how lame it is to say, what if you get hit by a bus tomorrow? It's absolutely true. Like stuff like that happens and
Well,
you don't,
it's just about peace of mind, because
yeah,
everybody's always going to wonder what if anyways. So while we don't want to dwell on it, it is there. So
yeah,
that's all. But we're not going to make it all about the fear and not only what if you get hit by a bus tomorrow, but we're happy to show you all the numbers and how destitute you'll be if you don't get it. So that's where it can be. But really, it's just about peace of mind. People just want to, like, all right, am I doing the right thing? Okay, cool. Now, where's the opportunity here? That should be the real story. It's like, take care of the defense, of course. You don't want to leave that wide open. That'd be stupid.
yeah. And I think the real opportunity there is like, okay, I'm covering these bases. Now I can go out and, maybe because I'm taking care of that portion, I can assume some risk pursuing opportunities out there, right? Because it's like, well, okay, if something happens to me, whatever, my family is going to be taken care of. Now you can go out and say, hey, what are some other opportunities out there that I can take advantage of now that I've covered all my bases? Whether it's starting a business or doing like coaching or what you and I are doing, right? There's tons of different things out there that allows you to do. Now you're not necessarily just having to go work this job day in and day out to pay for all the crap that you don't need. you know, you maybe you still have to do that for a little bit to cover some of the basic needs of living. Maybe you don't. But this is an important part of it. And so, I'll talk a little bit about the term piece first, right? I mean, that's the good thing about that is it gives you the most death benefit for the least amount of premium. The reason that they normally cost so little for given whatever rate class you are is because typically only 1 to 2% of these ever pay a death benefit. So insurance companies love these because you're just saying, like, you're contracting with the insurance company to say, hey, I'm going to give you a few $1,000s a year every year for the next 20 years, right? and you're just going to give me, in return, you're going to give me peace of mind, like you said. And if I'm one of that 1% of people that actually passes away in that time period, then my family's going to be taken care of. The thing about terms, though, is that they're temporary. You can renew them, but typically when you do that, you're going to pay significantly more. Like, I show people illustrations all the time, where it's like, hey, look, right now you're paying $1,200 a year for the next 20 years. However, when that 20 years is up, your premium goes up to 15,000 a year, right? And that's just assuming that you're at the same rate that you are now. If your health has declined or you've had some kind of injury or developed some kind of condition, it's probably going to be significantly more expensive down the road. And you know, one of the things about those policies too is if you go renew it, say you do get you go back and you requalify, and they say, okay, you're still really healthy. We'll give you this at whatever. It's still going to be really expensive. Maybe it's not 15,000 a year for 20 years. It's still going to be a lot more, because understand, when they give you this policy, basically what they're doing is they're saying, what's the amount of risk that we're assuming over the next 20 years? What's the dollar amount of risk that we're assuming based off of, who you are and everything that you have? And then we'll spread that out over 20 years. So they're not just looking at how much risk am I assuming for this person right now? How much am I assuming 20 years down the road, right? Because a lot of stuff can happen between now and then, especially if you've already got issues that are probably only going to get worse. These companies have spent decades collecting all this information about medical conditions and life expectancy and all that stuff. So they know how to calculate the financial risk for themselves. Yeah, I mean, that's the biggest thing about term, is that It's going to end, and then you're going to experience significant costs later on if you have to renew it. One of the other things that I like about terms, though, is that maybe you're like, hey, you know what? I really like the idea of the permanent and term combination. I think that's a good idea. However, I don't want to do it right now. Well, the good thing about that is you can get past the major hurdle, which is qualifying for the policy, and get that term policy issued. And then later on, you can convert some of that to a permanent policy. And I do that a lot. When I'm working with somebody who's getting out of the military, maybe they're 6 months to a year out, you know, that's a tough transition right there. And, you don't necessarily want to, maybe you want to be a little more frugal with your money. So that's typically what I tell people is like, hey, let's get you the term policy now, get you the protection, and it's at the least amount of cost to you. And then later on, after you've been out for 6 months and your policy has been in force for a year, now we can convert some of that down the road, because by now, hopefully you're getting your pension, you're getting your VA disability, you've got your income from your new job. Now we can start, once we've gotten past the bumpy part of the road, now we can go back and look and figure out like, okay, how much do we do now? What's the best mix of permanent and term for you?
Right. And that's just a little plug here. That's what I write about in the Survivor Liberty Plan here in this book, available now on Amazon, but you can also get the PDF version for free at survivorlibertyplan.com. But I don't I think I get people excited about the offensive function of the strategy, but uh, don't probably say enough. Oh, by the way, we could start, with the defense first, as you just mentioned, and that's, when you're in transition, especially if you already got your VA disability rating back. There's a lot of fluctuation going on in there, and so I just want to make sure people are aware of that.
Yeah. And so the other piece of that too is when you get out, you might go work somewhere. Oh, even when you're in, we have group insurance there. It's called SGLI, right?
Right.
I mean, that's actually provided through the insurance is actually provided through a third party.
Third party government
Yeah.
contractor,
It's
where
not.
you could just
Oh,
go to them directly and get the same policy, probably cheaper. And so that's a good example to show, how group works, how it's everybody's paying the same price no matter what your age is. That's kind of weird.
yeah. And the thing that I don't like about that too is like an E1 gets the same coverage as an O10.
Hmm.
Sure, the O10 has probably been around. Like he's probably got a bunch of other stuff, but I just think that's ridiculous, right? So, um,
I
yeah, I
think
mean, a
it's
group.
it's important to have as a blanket for, as people are entering service, not understanding what all this stuff is. Like, sure, but the way that, from what we hear and talking to people, is that, no matter how long I was in, it was always just go re-up your SGLI. It was almost like a requirement. And so I think people end up years later wishing they had made a private decision on some of these insurers, if only to get qualified before these things show up on the medical records. Then we can do the things you've been talking about, whether it's renewal or conversion. You can make those decisions down the road, and that's what we like about, our version of the strategy. Just start simple, get the insurability locked in, right?
Yeah, and the other piece with that too, like the government options that are available afterwards, you don't have to qualify for them, which to me, that's kind of the red flag there. Like you don't, a lot of people will be like, oh, it's great. You don't have to qualify for it. To me, I'm like, that's kind of a red flag, right? You don't have to qualify for it. Do you think that they're just doing this out of the goodness of their own heart? Or, do you think that this stuff is being provided to you because somebody in Congress was like, hey, we need to do this for the troops, right? We got to support the troops. And so we're going to do this. Just because it's free doesn't mean it's the best deal for you. But anyways, to get back on this, kind of talk about the components of the group. Most of the group, unfortunately, for the majority of people out there, that's the only life insurance that they might have is a group or a employer sponsored plan like that. And the problem with that is for a lot of those, your insurance is maybe 1 to 2 years worth of your salary. And I'm talking like outside of the military, right? Typically they'll have a group policy. It's 1 to 2 times whatever your salary is. So something else to think about, and we talked about this when we did the overview. Any premiums that they pay that's for coverage over $50,000 on you, those premiums that they pay are actually taxable income to you. Like that's something that you actually have to put on your tax return. A lot of people didn't know that. It's deductible for the employer, so they love that because they get to say, hey, we do these benefits. We do this group policy where we pay for your life insurance. However, it's not necessarily enough, and anything over that $50,000 amount is counted as income to you. It's kind of unrealized income. And then, most of these, they're always term policies just because permanent policies have tax implications. I'll tell you who does get the permanent policies that are provided by employers are like the senior level executives, right? That's a really common, because there's a limit on the amount of salary that they can receive because of the IRS. A lot of these companies, what they do is they have these extra benefits where the company pays for a permanent policy on these executives, and they can fund it with hundreds of thousands or millions of dollars to where they can take that with them when they leave the company. It's just another way of of saying like, yeah, here's this other way that we're going to compensate you.
And that's like a deferred compensation or gold cuffs or something like that.
Yep.
So business owners can use it to their advantage to retain employees.
Absolutely. Right. And then there's you can normally convert those to individual policies too when you leave the company. A lot of them have provisions where you can say, hey, I'm going to take this life insurance with me, but guess what? Those rates probably aren't going to be the same because in a group policy, typically the rate that you're going to pay is based off of an average of the aggregate age of everybody that works there. They don't, you typically don't have to qualify for those. They're going to look at everybody's age and whether they're male or female and say, okay, here's the amount the employer is going to have to pay in premium. When you leave, if you're an older male, your rates are probably going to go up, right? Because it's going to cost more to insure you on an individual basis. And then a lot of these too, SGLI doesn't do this, but there's typically a probationary period for group policies. It can be 6 months to a year. It just depends on how they set it up.
Okay, cool. So that was a pretty good overview. And Jared was asking a question in the comments. Permanent, when we refer to permanent, is that whole? And going back to the last episode, we kind of broke down the different types of permanent. I think typically in these employer-sponsored plans, that's where you'd see something like a whole life in a permanent policy.
Yeah.
Some of these programs where even as an employee, for the group insurance, you can turn it into it. So that was an option rare. I mean, or maybe it's around. I don't know how many businesses offer something like that. We don't hear about it much, but it's not a bad idea using not whole life, but the IUL.
Yeah. And, the benefit there obviously is because you still get the downside protection. You still get the tax deferred growth, but you get to take a lot more advantage of the upside than a whole life does, because it doesn't matter if the market does, 20 or 30%, you're still only getting your 5 to 6%. And, take it from somebody who started with whole life, right? I actually had one myself and I'm converting it using a process called a 1035 exchange into an IUL because I want to be able to take advantage of the upside a lot more and still have the downside protection. And I didn't know when I started in the business. Everybody's like, no, whole life IUL is whatever. And I just, like we talked about last time, I was like, okay, these guys that are saying they don't like it also don't really understand how to use it. They don't understand how to design the case. And they don't, I think a lot of it just came down to like, that's too much time and effort to learn how to do that. Right. Right. So,
Yeah.
and, to be honest, I think a lot of the times, given a certain amount of whatever you're doing, you probably get paid more for a whole life than you would for an IUL. So,
That is possibly true. But for me, it's about access. It's the fact that opportunities are showing up um, quicker than ever in different ways than you could have possibly imagined, um, and the flexibility you can have with this type of strategy. It's like, if you go to a company and you're vested and you get stock options, it's like, great, now I have a ton of money worth of Amazon stock, but if I sell it, I got to pay a bunch of taxes. And gosh, with the new tax rate, those capital gains tax are going to be 40%.
ooh,
What
yeah,
is the value of those Amazon options? It's still a chunk of change. You'd rather have it than not have it, of course. But when you get into these type of employee sponsored life insurance plans that may or may not start, typically you only hear about term and group, and that's why these conversations come up, because people think, oh, I got it through my employer. It's like, what happens when that is no longer the case? They're not your employer. And if you were an employer, to incentivize somebody to stay longer, if they build some equity instead of stock options, it works out better for everybody. You still get a write-off, and the employee gets a tax-free vehicle that does a lot of different things. So that's what excites me, is the flexibility.
yeah. And then, well, the other big piece of this equation is like, okay, how much coverage does somebody need? And that's, I'll tell you, the thing that really makes me mad is all of these online calculators that I see where people say, how much do you need? And they might go through their bills and say, hey, I need 50,000 a year will take care of me. Well, 50,000 a year will take care of you this year. Um, Something else that we've talked about in depth is that you need to make sure that you're increasing that amount every year to ensure that those dollars have the same, that's still going to take care of you, because, $50,000 today will have the same buying, 20 years from now, it'll have the same buying power as $36,000. I think it was something around $36,000, because it's going to decrease, like the value of that dollar. What did you say the other day? Like the value of the dollar has decreased by 96% over the
Yeah,
last 100 years.
since 1910, I believe. Yeah.
Yeah. So a lot of these calculators, they'll say, oh, you need $50,000 a year, so you need this much right now. And I'm like, that is completely incorrect, right? Because you need to increase that dollar amount that you're going to need every year. And who knows what's going to happen? I'm reading all these articles where people are talking about hyperinflation. What if that kicks in, right? That $50,000 might have the same buying power as $20,000 20 years from now, if something like that comes into effect.
If
Um,
somebody if somebody understands inflation, wants to protect it with a very large death benefit life insurance policy, let us know. Um,
yeah, right. And so,
that's the only thing you can do, is get more. I mean, that's how inflation works. Is $1 million is basically going to be $10 million, overnight.
yeah,
That is a serious concern. I don't know how it affects the insurance industry. Interested to find out.
yeah. So, when you look at like determining death benefit, there's different things that you want to look at too, right? What's the income stream that your family is going to need to take care of you or be able to take care of themselves after you're gone, especially if you're the sole breadwinner. That's super important. Most of the time they'll say, well, okay, you need a certain percentage of your current income stream, whether it's 70 or 80%. And, that comes from the fact it's like, okay, you're gone now, so we can do with 30% less income, right? Because you're gone, right? We don't need your car. We don't need, any of your stuff. But, the other piece with that is how long are you going to need that income stream for? I tell people, like, even some tools that you and I use, like I went in and changed the settings on them to where, because the old setting was, okay, you need this much income from now until age 67, because then you can take Social Security. I'm not counting on Social Security to be able to take care of me in my old age. One, because I don't know if I'll ever actually 100% retire. And two, like, even if I do, who knows, what benefits I might have available to me when that happens. So I don't count on that. I look at, like, I think they say right now, on average, Americans, males, average life expectancies around between 78 and 79 years. And I think for women, the life expectancies somewhere between 82 and 84 or 83. I mean,
I know it went
so
down a little bit this year because I think COVID was taking people out a few months early.
yeah, but now, they're talking about this more and more people are. I don't see that it won't go back up soon because they're, I've read stuff about more and more people are living into their 80s and 90s now.
Right.
And, if you look at uh, one of the reasons that life expectancy has gone up so much significantly over the decades is infant mortality rates have also increased. So it's not like it's a new thing that people are living into their 80s and 90s. People were doing that before. It's just now, a lot more people are surviving infancy too. That was a huge contributor to the increase in life expectancy. And I was kind of shocked when I read that. I was like, huh, it makes sense. But, so going back and looking at it, like, okay, how much do I need and how long am I going to need it for? I would not even think about factoring in Social Security into that equation, because right now I think the promise is that it's only funded until 2035. From there, they're not going to be able to keep up with their current requirement. So,
Here,
people are either going to
let me show you
start
this
getting
real quick.
yeah,
I know this is blurry, but it basically says starting in 2033, Social Security Trust Fund will only be able to pay 77 cents for each dollar scheduled benefits.
yeah.
So, yeah.
Benefits are going to get cut, and they're probably going to be getting cut more for people who have other assets than they are for people who don't. Right.
I mean, they're
So,
talking about that right now with the extra wealth tax
yeah.
above people with $1 million or something like that. Yeah.
And so, one of the other things to look at there is the income stream. Obviously, you want to be able to replace that. And then you also want to look at what are some major expenses that you might have, right? Do you have a business? Obviously, that's, it's an asset, but you could also incur some major expenses with the business. Is somebody going to take it over? Is somebody going to buy it? Is the business just going to go away? Was that person the business? You know, what would happen, if you were gone tomorrow? Like, would US Vet Well still be around?
Yeah, that's what
Um,
Key Man Insurance is
yeah,
for, right?
right.
It's like, what
And
is the value of either that what their skill set is, or notionally what their brand value is.
yeah, and so, that's a major expense that you want to look at. Like, your home too. Obviously, a lot of people, if they're smart, they're not sinking all their extra money into an asset that you know, they can't use any of the equity in it. Which I hope nobody's doing, because I, I got some bad news for you. If you're worth $1 million and all of your net worth is tied up into a retirement account that you can't touch for 10 years in a house, I call those fake millionaires. Like, it's just the best way I can be blunt about it. good on you for not having that expense anymore. But at the same time, that's $500,000 that you could be using, putting it to work for you instead. And, or, another 500,000 that you don't have access to. So anyways, kids education, that's another big one. That's really important for a lot of people, especially when you look at the ridiculous increase in the cost of education, which I think over the last 20 years has outpaced inflation by about 300%. The average rate of inflation is around 2.5%. The average increase in the cost of education has been at like between 7 and 8% every year. And that's just universities with bloated administrative department, or.
Well, guaranteed government grants.
Yeah. So, if you're a veteran, if you're a service member, there's also a lot of other benefits available to you to help out taking care of that stuff. Like in Virginia, if you're rated 90% or higher by the VA for your disability, your kids can go to school in state for, very little cost to you. I think they cover tuition, housing. I don't know if they cover meals, but, supplies and stuff like that. I mean, that's a huge thing. I was talking to a guy in 06 who's retiring. He's like, well, I'm retiring after 30 years. I got to work for another 5 or 6 years to put my kids through school. So I sent him a message with the link to the Virginia Department of Veteran Services website and said, hey, let's talk about your VA disability, because maybe you don't have to work for another 5 or 6 years to pay for your kids' school. Mm-hmm. Maybe if, you can take advantage of all the beating that your body's taken over the last 30 years and use that as an asset, So that's another big one. And then, of course, creditors that they might have. Maybe you owe somebody money for whatever. I mean, there could be tons of things that people owe other people money for. But you want to be able to make sure that you can absolve that if you need to once that person is gone. And so, as far as figuring out the amount that you need, obviously you want to look at big picture. Maybe you just if all you're looking at is life insurance, maybe they say, hey, you need $1.5 million, right, to take care of your debt and provide an income stream that'll take care of your family. What other assets do you have? Well, I have this brokerage account with $250,000 in there. And then I have a retirement account with, another $300,000 in there. Okay. Well, that's stuff that can be used to fund those goals, not necessarily now, but down the road, especially with retirement accounts. There's some stipulations on that. If you're not a spouse and you inherit one of your parents' retirement accounts, you've got 10 years to actually use that. Right. So, all that stuff, there's going to be other taxes, associated with that, when they close their estate. There's a couple other different methods of determining how much you might need. One is the financial needs analysis, which I think we talked about last Wednesday. That's essentially saying like, hey, how much money do I need if I'm willing to liquidate the principal of, whatever it is I need in order to pay for everything that I have, right? And then there's the capital needs analysis, which is how much would I need in order to take care of all these things without touching the principal amount, right? How much do I need to provide me the income I need to take care of everything and leave that principal amount intact so that I can also leave a legacy for, my kids or whoever. So those are two different amounts, right? If maybe if you just need an income stream and you don't care if you run out of money at the end, that's kind of what the financial needs analysis is. The capital needs is how much do I need to make sure that I never run out of money and that when I die, my kids still have, $1 million. That's a completely different equation altogether. And it's going to be a lot more than, the first one. And then I think probably the last thing that's important, especially with like term policies, shopping out your coverage. I mean, there's a ton of different insurance. I mean, just you and I, like, we can work with like 70 of them. There's 70 different insurance companies that we have access to, and that's not even all of them, right? Those are, but there's tons of insurance companies out there. The best advice I can give somebody is like, don't pigeonhole yourself into one, because that's all you're going to get. Maybe there's something out there that suits your needs a lot better. Different companies are good for different things. Some of them handle special cases, like if you've had cancer in the past, or some kind of sleep apnea or something like that. I mean, you and I learned about that, I think, last week. It's like, oh wow, there's an insurance company that specializes in sleep apnea. That's
Yeah.
cool. Right? If you just go to one insurance company and talk to somebody who's a captive agent there, like, it's like, yeah, you can only work at this one company. Guess what? That's all you're going to get is their stuff. So that's the advantage of going to somebody who's licensed through a broker, is that they can shop all that stuff out and actually figure out like, okay, which one is the best one for me.
Right on. Well, cool, man. Well, no, that was definitely a great overview of the options for group and term and how to think about that kind of stuff. Um, we put the link here for a lot more content on that subject. But if you want to contact us, of course, hit up Trevor or me on LinkedIn, and happy to chat with you about it. But Trevor, I know you got a call coming
Yep.
up right now, so we will call it a day.
All
All right.
right. Take care.